Hello, everyone. Welcome to the GHV Accelerator webinar series. This is our fourth webinar, and GHV Accelerator is an accelerator with a difference. We help startups raise Series A funding fastest possible. I am going to be introducing you to our speakers, Prajakth Raut and Mukul Singhal. Prajakth Raut is an entrepreneur and entrepreneurship evangelist. He is the co-founder of ApplyFi and the founder of the Hub for Startups. Also, he is on the esteemed list of mentors at GHV Accelerator. Prajak's personal goal in life is to encourage and assist alert people to become entrepreneurs. Project mentors startups on strategy, business model, and monetization, fundraising, and on preparing the company for growth. Welcome to Mukul Singhal as well. He is the principal at Saif Partners. He leads early and seed stage investments at Saif Partners. He invests actively in consumer, internet, and mobile. He has led Saif investments in companies like Prop Tiger, Touch Talent, DSYN Technologies, Travel Triangle, Topper.com. Mukul is also a Thai Charter member and actively participates in the Indian entrepreneurial ecosystem. I welcome you both to the webinar. Over to you, Prajakth, to take this forward. Thank you so much, everyone.
Thank you very much, Ritika. I'm just trying to figure out how do I share my screen from here, Ritika?
Prajakth, on the top right-hand side, you will have a drop-down saying screen sharing.
I usually used to get that. I'm just not getting it right now.
Where it is top right.
Yeah.
Sorry?
So where it is top right.
Yes, top right. Wait, let me give the presentation rights to you, Prajakth.
Oh, yeah, I don't have the presentation.
Yes, I'm just giving that to you. Yeah. There you go.
Why don't you share your screen, the presentation video?
Yeah, I can see the screen now. Are you able to see my screen?
Yes, please.
Okay. So, Ritika, thanks a lot for the introduction. Mukul, welcome to this webinar series as well. Ladies and gentlemen, thank you for joining up on the webinar. It's interesting to see a lot of these initiatives which help entrepreneurs understand different concepts about entrepreneurship and startup, including things related to funding and building the business. What we are going to talk about today is a topic that is most, necessary. It's a platform that I have launched to help entrepreneurs connect with potential investors. What entrepreneurs
Sajid, I am losing you in between. I'm not sure if everybody is facing the same problem.
Sorry, Mukul, what did you say?
I'm thinking I'm losing you in between. I'm losing you in between. This is Mukul. I'm not sure if everybody is facing the same problem.
Ritika, were you able to hear me?
So losing you in between for a couple of seconds.
I see, okay. So let me just start I started by introducing myself. My name is Prajakth Raut, and as Ritika mentioned, I am the founder of ApplyFi. It's an online platform that I've created to connect startups with investors. And what startups get when you register onto the online platform is a very elegant online pitch deck. In addition to that, you get a scorecard for your startup. Think of it like a GMAT score for your startup, which will help you understand the strengths and weaknesses of your venture seen from an investor's perspective. So that's the introduction about myself. Now, today's topic is about matrix, and before we request Mukul to share his perspective on matrix, especially specifically matrix that they look for in going to Series A, just wanted to set the context. Quickly run this in about 7 to 8 minutes. So, matrix are essentially parameters that you would understand or that you would track to assess how well you're doing in your business and how your progress is. It's not just necessarily to track what is not working or how things are working, but it is also to track what is working so that you are able to replicate that at scale. It's about understanding different, or it's about dissecting your business in different variables so that you are able to isolate things that did not work well, and you're able to isolate and identify things that worked well so that you're able to replicate at scale. Now, because we are talking in the context of startups and startups going up to a Series A level, need to recognize that there are two different phases of a startup's journey. At the beginning phase is about is about discovering what is working, and that could be the POC stage, pilot stage, etc., where you're doing a series of experiments and testing various things and learning as you go along. And after you have identified what has worked and what has not worked, then the growth phase or the scale up phase is all about replicating what has worked very effectively. And therefore, as you will realize, the metrics that you use at the startup stage are going to be significantly different than what will go at the kind of metrics that you will track at growth stage. What matrix helps you do at the early stages is understand what is working and what is not. And what typically investors would want to see from you is what have you learned that can be with reasonable probability say that I can this will work in the same manner at scale as well. What metrics also do is give you early warning signs, whether they are good or bad, which say, hey, this seems to be not working as I had estimated. Now, the point about talking about this is matrix is an indicator for you to find out and really nudge and find out what things are not working for you. Typically, a lot of times, entrepreneurs tend to gather data that validates whatever their assumptions are. But I think it's important also to figure out what is not working, because a business plan or executing on a business plan is not about just executing the plan well. It is about understanding what the market realities are, getting enough data, getting actionable insights, and therefore adjusting your plan in a manner that you are still directionally going into the same track. Now, a lot of times we get asked in terms of, hey, but business plans never work out in the way they did. So what's the point of tracking matrices, etc.? Should we be doing it when the business becomes a little more predictable than at the early stage? And in fact, it's because business plans, as you have assumed them to be, do not necessarily play out in the same way in the marketplace. It is important for you to map whatever your assumptions and whatever your plans were versus a set of data points that you gather from the market so that you know which of your assumptions are proving out right and which of your assumptions that you had made are not working out in the way you had estimated them to. It helps you take better informed decisions about changing direction. It also helps you dissect very clearly what specifically is not working within a particular thing, and we'll discuss some of these things as we go along. I just wanted to break a couple of myths about this. Typically, entrepreneurs expect business indicators to improve over time. And while some of them will improve over time, and overall as a business there will be growth, not all matrices need to and will not improve over time. Also, matrix is not about understanding what has happened so far. It is about being able to use that data to assess how things will move from there onwards in the future. It's an indicator of what has happened, but it is more important for you to analyze the cause of why these are happening so that you will be able to take that out to further. For example, it's always easier to grow. I mean, when you have say 10 customers, you can easily go to 50, but when you have 5,000 customers, taking that to 25,000 is not going to be exactly at the same scale. So be ready when you say that it's okay to have matrices that deteriorate over a period of time as long as you know that it's directionally going in the right path as you have wanted it to be. Often we see this mistake being done by early stage companies where entrepreneurs say, hey, but my cost of customer acquisition is just rupees 100. I don't know why the market is talking about 2000 rupees and stuff. Now, early customers, because of various factors, including that you have been able to activate your network and so on and so forth, you probably could get them for free. But that's not the point. What the point that you need to understand is what is the data that I can gather to assess how much it will cost me to get that next set of customers, and therefore what metrics can I use to see what I can predict over a period of time as being my cost of customer acquisition. Similarly, early successes or initial successes, if they are not replicable, is not the data that you can share with investors, or not a data that you yourself should use to estimate how things will go on from there. And for example, when you're talking about B2B customers, enterprise customers, when the founders go to sell because of who you are, how you dress, how you talk, and the passion that you bring in, sales closures become typically a lot easier. However, that is not a replicable program. If it is not, and if you're going to deploy salespeople, what you need to measure in your pilot is also how does the sales cycle work in a manner that can be replicated over a period of time. Similarly, in some of these things, PR efforts, email marketing, SEM, etc., they have a limit to which there will be action and outcome as a result of doing that. But beyond that, they won't be able to scale up. Things like R2, etc., may decline over a period of time, especially after you extend beyond your core target audiences. I'm not going to go through each of the details of the bullet points here, and the presentation will be later available for download if anybody wants it. But the point that needs to be done is that the matrix that you will track over different stages of the company will change. At the concept stage, you're trying to get qualitative insights about the problem that you want to go after. What is the issue that I'm dealing with that will make the customer like what I'm doing? Who is the right customer? And when I say who's the right customer, what segment about the customers am I looking at? And once you have an answer to some of these things, designing the product or the solution that you will have for that problem and for that customer becomes an easy thing. To give you an example, if you were making another mobile messaging app like a WhatsApp, it's unlikely that you will get enough traction. You may, but that the probability of success is far lower than probability of failure. However, on the other hand, if you were to say, look, I'm creating a mobile messaging app for the medical community or the doctor community, you may have something going in for there. But if you ask doctors what is it that they seek in a communication platform like this, you may be able to define who specifically your audience could be, and therefore you might be able to design some features in your product that is relevant to that particular community. So at the concept stage, it is about discovering what problem to go after, is there a large enough market for that, and how that product needs to be delivered. At the POC and the development stage, hopefully if you've done the first stage well, if you've done the first analysis well, the POC stage should be just about focusing about how to get people to love your product and keeping on refining the product to ensure that the product is designed well. This is POC stage is not about traction, it is not about getting volumes and so on and so forth. It is just about focusing deeply about developing the product well. Likewise, when you move on from a POC stage to the beta stage, you want to test at a smaller scale the different variables of the business. And don't go by the sub bullet points onto that, because these are just indicators. But what you want to understand at the pilot or the beta stage are, how are registrations moving? What are they moving for? Are customers referring to others? If they are, why are they doing it? So while you will analyze some of these points, or each of these points and many more points, what you also need to track in your matrix is the reasons for that. If the registrations were assumed to be 22%, if your conversion rate was say assumed to be 22%, but if it is actually 32%, great news. But unless you know why it was 32%, it has very little relevance, because you won't know what to replicate at scale at a given time. Similarly, after you have done your pilot and you've done your experiments, and some of those experiments will work and some won't work, when you have discovered what works, The next phase, which is about executing that at a larger scale, is all about using matrix that will help you improve your performance, or it will help you improve the efficiency at which you operationalize your venture. Moving on to the next point, different businesses will have different metrics. So don't look online for a template that say, hey, this is a template that investors look for, or this is a template that most people are recommending. There are enough things going around, top 10 metrics that entrepreneurs should track and so on and so forth. Well, all of these are good. Every business will have very, very different needs. In fact, the same business with different business models will have very different matrices to track. And in fact, if the same business with the same business model done by two different people with different skill sets, competencies, challenges, circumstances will have very different matrices to track as well. And as you can see, I mean, different kinds of business. If you are, say, for example, creating an online magazine for college students, uh, uh, if one person is going after, if there are two people doing similar business, one with a subscription model and one with an ad supported model. In the ad supported model, how many times the person is coming every day, how much time is he spending every day, how many occasions in a day is he coming, etc., etc., would be relevant. In a subscription model, that may have relevance, may not be as important as in the case of an ad supported model. In the subscription model, I don't care if that person spends 2 hours spread across 5 days a week, or just keeps this as weekend reading, because the parameters for where my business will succeed are going to be different. Similarly, across different kinds of industries, etc., the matrix that you will track will be very different. Uh, Understand very clearly what is important for you to track, and create a table which typically looks like this or any other way, which gives you actionable insights. uh, in this example, I've got this month, last month, but it could be this day, that, yesterday, it could be week, and so on and so forth, depending on where you are. And while you track difference between whichever your control point was and whatever your current point is, and that percentage growth or decline is important to track. What is also important in early stages is to do a trailing 6 months average, because that will give you a good indicator of how things are working over a slightly elongated period of time. Immediate data points, last month versus this month, etc., while interesting and while important to track as well, sometimes can mislead you, because could be other influences and triggers that may not be budgeted. But you do it over an extended period of time, and you do a 6 months trailing average, it gives you good indicators. And of course, you should map that against your goals and deviations. Also need to remember that early stages, because you will deviate from your goals. Your business plan was a set of assumptions. It is not, if you deviate from your goals, even say, for example, negatively, it doesn't mean that your business is failing. It just means that you've discovered what could be an in-market reality, and it is important for you to go and then adjust your business plan as you move along. Remember, matrices are important from a point of view of providing you some level of predictability of the future. It is not just about providing you data about how things are done. Other important thing to track is the source of business. Where are my customers coming in from? Track what are the triggers. For example, is it only because of a promotion, or are they buying into the core value proposition? Customer engagement and so on and so forth is to do as well. Quickly, last two slides, I'll sum this up. One, unless you act on the matrix and the data that and the intelligence that you got from that, it has really no value. You need to be able to ask the question, what does this mean for my business? What can I do out of it? What are the action steps that I'm taking? And what are the worrying signals, or what are the positives that are coming onto it? Matrix is not a occasional activity. This is core to your business strategy. It is core to understanding where things are going, and therefore you need to make time for it. When I say you, it every single individual in the organization whose action or decision impacts the business needs to have their own set of data points that they need to look at relevant periodicity. And collectively as a group, you need to be able to discuss some of these things. Focus on what's important. there are some metrics that will make you feel happy, and you need to look at those as well, but also proactively look for data points that will cause trouble or that will tell you all's not well in this business, because it is better for you to discover that in as you progress along, rather than discovering it in the market. Hiding or not knowing the mistakes doesn't mean that those mistakes or things that are not working out will not go out well, but it's very expensive to discover that mistake or what's not working in the marketplace. It's better to discover it at pilot stages. When you see something that's not working, assume that your conversions are not happening. Don't assume that the product is, a lot of times we see entrepreneurs make the mistake saying, hey, our conversions are not what we had expected, maybe something wrong with the product, and they go on tinkering with the product. Maybe there is something wrong with the product, but that need not be the only trigger because of which conversions are not happening. Dissect every single variable that is likely to influence a conversion, your conversion rate, and maybe it's the product, maybe the pricing was not right, maybe the target audience was right, maybe they do not understand the value proposition, maybe the value proposition was right, but they don't get it. The communication is not very clear. Maybe the messaging was not right. Maybe there could be several factors because of which the conversion was not as was expected. So drill down. Likewise, even on the red flags, if something works really well, of course be happy about it, but also analyze what has worked well, because what you want are a set of variables that you can say, hey, this seems to be working well, let me focus more on replicating that at scale. Hmm? Also, it's good to share some of these data points with the team. If you have a habit of getting into matrix, etc., it provides you enough data points to share with the team. And there's an interesting framework that some people suggest. And on each of these 5 points, acquisition, activation, retention, referral, revenue, you can have a set of data points within that, relevant to the stage, relevant to the business, etc. But this is a nice set of 5 parameters on which, or not parameters, 5 buckets under which you will define several parameters to think about your business about. So to summarize, metrics are things that will provide you actionable insights, and actionable is the key word onto it. Getting insights is useful, but if you don't act onto it, it doesn't mean anything. Customize a matrix, decide what's relevant for you. Don't look for templates. Think about what are the drivers of my business and how you're going to go about it. Different businesses and different stages of the business will have different priorities and different matrices. Identify what's right for you at what stage. Look for early warning signs, look for the red flags, proactively seek them out so that you'll be able to take corrective action. And startup phase, and why all of this is relevant, because the startup phase is not about saying that I had a hypothesis and see how well this hypothesis is working. The startup phase is about saying I have a hypothesis and then understanding what it takes to prove that hypothesis in the market and what are the variables that need to work in conjunction with each other. The reason why all of this is important is because, as I say, for a startup to work or for any company to be successful, 20 things need to work well. For it to fail, just one or two of them need to break for that company to fail. It is therefore very, very important for you to keep on making adjustments and understanding what is working and what is not, so that you're able to get a good sense of, okay, this seems to be replicable, and then replicating that at scale. So thanks. That was, I think I took a little more time than I was allocated, but with that, over to you, Mukul. I'd request you to give your, views on Matrix, and then I have a few questions that I need to follow up on. Ritika, if you can unshare my screen now, or do I do that from here?
No, I'll just do that for you, please.
Okay, stop sharing screen. Was the audio clear, folks?
Yes, please. Mukul, I've shared the presenter rights with you.
I'm not sure whether Mukul has. Do you have a presentation, Mukul?
Yeah, there are 3, 4 slides, project.
Oh, wonderful.
Can we see the slides?
Yes, please.
Ritika, Project, can you see
Not yet.
my slides?
I can see that.
Okay, so I'll start. I think quickly, folks, I'll give an brief introduction about SAF Partners. It's just we are investing into India since 2000, 2001. State and sector agnostic fund. We are India China fund. So I have seen fairly across business cycles, full life cycle in India investment journey. On the second slide, we have done across the stages, we have done anything which is less than $2 million. All the logos and the brands are written here. Companies like Take My Trip, Just Dial, we were the first institutional investor, but over the years of time have kept on backing them. Companies like Paytm, Book My Show, big brands, don't need any introductions. So just a small brief on SAF Partners. Now coming to the fourth slide, which is the life cycle of a startup. And this I have largely put uh, just to put the context on what kind of matrices are needed, what investors look for, some of those questions. And this is a very ideal case scenario that the companies grow, they raise angel money, friends and family money, they take seed money, early VC, and what kind of things we need to look for as a life cycle of the company. So if you see the first part, I'll go through some of these matrices, some of these concepts, and we'll try to convert them into matrices. And some of these, I think, Project has already alluded to in his presentation. So when the company is just forming, when you're looking for friends and family, angel, it's an ideation and concept stage. Typically, people, as an entrepreneur, you and people like us will look for the market feedback, something like market sizing. What customers are saying is that you make your product, you roll it out, you let consumer taste your product. It's like something around seed. You figure out what the customers are saying. You take a customer's feedback. You hire a core team around you. That's one cycle. Then you move that. You raise your Series A. I think the Series A, this box here is some. I think it's just got cut, but effectively it allows you prove your unit economics, you prove your channel economics, you prove something of that sort that if you're selling something for 5 rupees, 3 rupees is the cost, 2 rupees is what I make, and hence this is my unit economics. You prove some of those things on our VC cycle. The growth VCP, you go, you're now if before growth VCP, by early VC you have proven two things. You have proven that what I have given as a product, what I'm selling to consumers sells. Consumers want it at a certain price point. I can deliver that product, or I can deliver that service. The unit economics of that delivery is this X plus Y minus Z. I can hire team. So some of those things you have proven. You go for a growth VCP kind of journey. Then you have to prove more on the growth, scalability, processes, profitability, some of those parameters, and then the journey goes from there. You go from the IPO and all. This is a classic ideal case scenario of the company life cycle, and we'll talk about it when some of these things get distorted. In the next slide, you can also think these stages in various perspective. So, for example, product market fit. When you are on angel stage or seed stage, you are trying to prove the product market fit, that this is the product I'm selling it to consumers and consumers are liking it. Yeah, this is called a product market fit. You can prove a product price fit, that this is the product I'm selling it for 5 rupees, and economics is that you put your price and costs together. So that all these three things you prove from somewhere in journeys like angels and VC. So these are the risks in the businesses you get down to. When you come to the growth, VC, you prove more channel scalability and growth. There are two, three ways to look about your business. One is the risk ways, and this is the risk perspective. And the initial graph is more around. You can put various matrices around this graph. Now, question is that life is not simple, isn't it? Life is not ideal. We have so that's a theoretical way of looking at things. There are various constraints in an entrepreneurial journeys. You don't have money, how do you do it? Is it you can't hire a good team because you don't have money. You can't raise money because you have not done those two things. So it's a vicious loop. How do you solve it? Macro environment is bad, VCs are bearish, market is not growing, then what is the point of doing all those things? Those are the typical questions which comes out on a day-to-day basis. Fourth is my competition is crazy. They are pushing a lot of discounts. I am doing it in a fundamental manner. So some of these things comes as you prove as you go on your building a company kind of journey. The macro environment, the constraints while building a company keep playing it, and you have to think that what constraint to lose and what constraint to pick. So, for example, I have seen many entrepreneurs that they are not able to raise money, so they go on a cash accounting. Isn't it? You run your company as far as cash is coming in. You may do certain things which are not fitting into the strategic direction of the company, but that's giving you the cash. It's making you earn your bread and butter, and you have to do it because that's the constraint in life. I've also seen companies where, because of some reasons, they have been able to raise a lot of money due to market condition, due to their team ability, due to the attractiveness of the market, whatever. There can be various reasons for it. And but if you have the luxury of amount capital in your bank, then some of those journeys like unit economic growth, you can change your sequencing. So you say that I have to grow fast and I kill my competition. My competition is giving discount, so I'll also give discount. So you probably prioritize growth than unit economics. So all these things, as an entrepreneur, you have to play that this is my macro environment, this is my constraints, this is what I need to prove, and hence let's juggle my balls. So this is what I have to say on. I have not any slides. I'm happy to take questions, and we can take these 2 3 slides as context, and we can go in a Q&A board.
Thanks, Mukul. I'll throw a couple of questions, and perhaps then, Ritika, are participants on mute right now?
Yes, yes, Project.
Ritika?
Yes, Project.
Yeah.
Yes, Project.
So, folks, yeah, if you have a question, you will see the symbol of a hand next to your name. Just click onto that, and Ritika can then unmute you if you have a question to ask. And while participants get familiar with that, I just wanted to throw a couple of questions at Mukul. Mukul, on going by data versus going by gut, there are two different schools of thoughts, right? Some people prefer early stage entrepreneurs who go by gut, especially those who are creating that market. How does one balance this thing with, what the market is telling you versus what your intuition tells you and your conviction tells you?
Project this is a fairly fine balance, and all the teams have to create this fine balance. And this challenge every founder face on a daily execution cycle. My personal conviction is that it's a mix of both. So don't, if your gut is very strong on something, do that part. Do that part. Isn't it? Don't get a prisoner of data and analysis. Having said that, it's very important to take the feedback loop in the terms of data. So let's say your gut is saying I have to do these ABC and ABC things. You should do those ABC things, but at the same time, there's always a thin line between perseverance and stubbornness. If you have done A right and there is a data which says something about it, you have to take the data back into the decision making cycle. It's not that you can ignore data always and always keep on going gut, but your gut can define what you need to do. But do you press your pedal on that, or cut your losses? That should be data driven.
Fair enough. And thanks, Mukul. you must be seeing a number of entrepreneurs come to you with at different stages. Now, also given that you folks invest in very early stages, and we see uh, uh, entrepreneurs who've not had the opportunity to take institutional capital and therefore may not have had that much mentoring. What are some of the mistakes that you see early stage entrepreneurs make regarding matrix, and what are some of the two or three observations you might want to give us insights and inputs?
Project, I didn't understand the question. Can you come back again?
uh, Entrepreneurs, when they come to you, what are two or three of the mistakes that you see them related to matrix that you see them make? For example, one of the things that I often keep seeing from entrepreneurs is, oh, but my cost of customer acquisition is just 40 rupees. Uh, and what is your observation and two or three things that sort of entrepreneurs are not understanding in the context of matrix?
Uh, I think most of the times, one common mistakes in terms of matrices, which happens that somewhere there is a notion and uh, general consensus, general chatter in the ecosystem that VCs want to see big numbers. So they will bring some financial model. They will just show some big numbers on the Excel sheet, and they are. And when you go deep, then the base behind that, or they will not have any knowledge about any of that. So the basic assumptions behind those numbers would be all wrong, would be all over the place, and that pretty much tells that either there is not enough groundwork done, or or uh, uh, it's a shallow, or execution is bad. It creates a red flag in our mind. So I think vision of big is important, but handle on the bottoms up is equally important, because that shows something about your execution capabilities. So you have to balance both the things.
Okay, great, thanks. Have you at Seth, do you put premium or including the overall the VC community, do you put a premium on teams that are doing reasonably well in tracking matrices, etc., versus teams that may be reasonably successful but don't have a basis for understanding what worked and what did not?
So project थोड़ा contradictory है, so reasonably successful unless you have the basic doesn't happen. Hello.
Yeah, but for example, a team. Hello, but a team, for
But
example, that has
unless
all the
you
data points in the.
tell me.
Oh, sorry, go ahead, Mukul.
I'm saying that if the team is reasonably successful, they will have idea what is happening on the ground. Maybe at times when you go into the venture capital communication of a fundraise for the first time, I've seen that there are a lot of wrong notions. So they are hesitant to tell the data. There are communication issues. All those kind of things do happen, which are fine perfectly. We do spend a lot of time with the entrepreneurs to give them comfort and try to understand, ask the right questions. But my view is if team is doing reasonably well, they will have handle on the data. Otherwise, it's very difficult to do.
Yeah.
Then
Have
we are missing
you
something.
have you ever turned down a transaction that looked or smelled well, but there was absolutely no data or metrics that were tracked to understand why it worked well? In the sense, is a predictability of replicability of
Yeah.
that success is.
So predictability of that success may not be important, because it also depends on the stage of the business. If I'm doing a early stage transaction, I might give some buffer into that. In the later stage transaction, we will not do that buffer. Having said that, let's say if you have shown some stage of the business that my business is doing these numbers, and you are not actually able to explain that from where those numbers have come up, how the tracking has happened, then that's a fairly negative sign. And then the question may even go to the corporate governance, ethics, all those kind of things. Uh, uh, So, because you have to convince us that this data is right, this is what it is happening. So, unless there's the base level of tracking there, how you know that this data is right? Obviously, we
Got
spend
it.
time with the teams to figure out that if they are bottlenecked by something, which we help them to remove that bottleneck. But we would like to know that how the data is coming.
Fair enough. Thanks, Mukul. That was all these things were very insightful. Folks open for questions now. Ritika, I can't see the rest of the attendees, but if you see some people with a palm marked against their name,
Yes, yes,
kindly
Pradip.
announce their name and kindly announce the name and unmute them.
Yeah. So, Ravi Mittal, I am going to be unmuting you so that you can ask your question directly to the speakers, please. I've unmuted you, Ravi. Please go ahead.
Yes, I have a question for Mukul. Mukul, I've seen a lot of my competitors who have been gaining traction through unethical methods. Like, let's say they want to increase the registration count or increase the app download count. They incentivize these downloads or registrations, and they have shown an large number of attraction. So, how do you go about doing your due diligence whenever these people try to approach you for funding and all?
So, maybe on due diligence, we and fairly when somebody has used unethical means, what project was saying that this starts happening. Let's say if you have shown that I've got 500,000 downloads, and you've used an unethical means, and when you dig deep at how those downloads have come up, what is the cost of conversion, how the funnel looks like, what is the channel, then all that conversation starts breaking up. It rarely happens that somebody has used unethical means. So, see, if there is some unethical somewhere, something starts breaking up. So even let's say you have done instant downloads and you have got million downloads, your consumer feedback will go haywire because you have done instant downloads. Because what consumer was looking for didn't happen, and consumers have just shot you down on the reviews. Maybe something will start breaking up, or you didn't have a clue of the conversion funnel. You try to figure out that uh, what are such signals that if somebody has used something of that sort, and at the end of the day, we also do end up in making mistakes in judging entrepreneurs or in judging teams. But if there are unethical ways, then something starts breaking up. If not in month one, then in month 10.
Uh, okay.
Thank you, Ravi. Thank you, Mukul. Our next question is from Navkaran Chadda. Navkaran, are you there? I'm just unmuting you. You can ask your question, please. Navkaran, can you hear us? I think
It will
Navkaran is.
also be helpful if I can
Hello.
get to know that
Hello.
people. Uh,
Yes, Mukul?
Hello.
if people can introduce me to their companies as well, so that at least I can get to know which what is their are they running a company or they are working somewhere, so that I can get some background.
Yes, that's totally agreeable. So I think Navkaran is not there, but he did have a question. I'm not sure because he's not. I've unmuted him, but he's not taking now. So he's saying that VCs research a lot before investing in a business. What research should an early stage do to find a good investor, and what metrics should a startup to look for the right investor?
So is the question is what research startups should do to get to on VCs to get funding?
Yes, yes, please.
Got it. So there, I think that's very important, and finally, you should figure out, you should know that what the VC is all about, what is their feedback in the market, how they have. So stepping back a little bit, growing a company, building a company is a fairly painful exercise. It looks glamorous from outside, big exits, all that look glamorous from outside, but as an entrepreneur, these are fairly painful and fairly stressful journeys. And as a venture person, as a board member, the person has to go through with that journey with the entrepreneur, and entrepreneur should be able to seek support from that person. So it's very important that you can connect with that person. You can, if there is a pain, then he can be of support to you. You can look up to him. So people should do that check in the market. They should figure out that how they have behaved with their portfolio companies, what kind of help they do, how approachable they are once they are on board. So all those kind of research they should do. Is their investment philosophy matches with their company philosophy? Is that something you want? You you think it's a very long term game? They think it's a very small term game. All those things. As much as you can do research, you should do research.
Thank you, Mukul. I hope Navkaran then answers your question. We have another question by Justin Silas. He's saying that we provide solutions for the hospitality sector, currently self funded. We have initial tractions and we're looking to raise funds. Why is it that most initial investors are not looking or not willing to do the valuation, but just to follow the fixed equity for fixed money, irrelevant to required money?
This I didn't get this question.
I'm sorry, this is just a typed question. I wish Justin was around. I will just quickly unmute him and see if he's available. Justin, if you can hear us, would you like to ask your question directly to
Yeah,
Mukul, please?
but yeah, but Ritika, I'm not so sure whether this may be a relevant question, but it may not be relevant to the topic today.
Okay,
So,
right.
folks, keep the topic, keep the questions to matrix related to that. And if there is a different question, do send it across to Ritika. Ritika, you can just type Anurag's mail ID perhaps, and we'll address those questions separately.
Sure. So I don't see any more raised hands. If everybody can hear me, do let me know, and I can quickly unmute you to ask your question directly to either Project or Mukul. Okay, so no questions just yet. In case you have any questions, you can directly write to us at anuragkapoor@ghvaccelerator.com. It should be mentioned that the email ID is mentioned on the slide that we shared with you. We can just give it another more minute in case we have any further questions.
No, I think if there were questions, they would have come in now. We can, I think, safely, call it a day for this one.
Sure.
Hey, Mukul, thanks a ton for time for this. Ritika, thank you for coordinating and organizing this.
Thank you, everyone.
everyone.
Thank you, Project, and thank you, Mukul, for being a part of this. Please do keep attuned to more webinars coming from GHV Accelerator. We look forward to seeing you in our further webinars. Thank you so much, and everyone have a great evening. Thank you. Bye bye.